You watch the price break an important resistance level, take a long position, and immediately get stopped out as the market violently reverses. Right now, retail traders are aggressively opening short positions against Bitcoin, betting the rally is over, while institutional capital sets up for another push higher. Most of this retail behavior stems from a heavy reliance on the 4-hour RSI. Traders see an overbought signal and assume a crash is imminent, ignoring the broader structural context. We are going to map the exact liquidity metrics and macroeconomic data, proving why this specific breakout operates under a completely different set of rules. We will look inside the derivative heat maps to locate a massive, untapped target sitting squarely at $78,500. Understanding these mechanical gears allows you to align your strategy with market makers instead of providing them with exit liquidity. Bitcoin does not trade in a vacuum. The current order flow across the entire crypto ecosystem is dictated by traditional equities. To understand the floor under Bitcoin's price, we must look at the S&P 500, currently holding securely at its all-time record highs. Bears quickly point out that the S&P 500 is flashing heavily overbought on the 4-hour RSI, but traditional equities can sustain these overbought conditions for weeks or even months without triggering a major correction. This sustained equity strength creates what we call the macro buffer. The macro buffer is a phenomenon where extreme stability in the stock market acts as a concrete floor for crypto prices. As long as the stock market holds its ground, short-term pullbacks in Bitcoin operate strictly as high-probability accumulation zones. History shows that the crypto market rarely breaks into a sustained downtrend while the stock market is holding at record highs. This establishes our baseline trading rule for the week. While traditional liquidity holds steady, severe downside risk in crypto is tightly capped. Any trader trying to short Bitcoin without first checking the S&P 500 is flying blind to the actual market floor. With that macro floor established, we can zoom into Bitcoin's immediate battleground, sitting between $72,000 and $76,000. $76,000 is the absolute ceiling of this current resistance block. See the difference between a momentary intraday spike and a confirmed close above resistance. A 3-day candle close filters out market noise, validating institutional commitment. Compare that to a fakeout, where price pierces resistance but immediately collapses, leaving a long wick trapping aggressive buyers. So what happens if this breakout fails to confirm and equities begin to cool down? The first line of structural support during a pullback sits precisely at $73,700. If that level breaks under selling pressure, the secondary fallback zone awaits at $71,000. Pre-planning bids at these specific levels removes emotion from the equation, ensuring you acquire assets during dips instead of panic selling the bottom. Waiting for a confirmed 3-day close or bidding at established support shifts your position from guessing to reacting to validated institutional data. If the breakout holds, the immediate end result target of this bullish cycle is a massive untapped level sitting at exactly $78,500. This $78,500 target is a direct mapping of current raw leverage data. This Bitcoin liquidity heat map shows intense, glowing red concentration bands, enormous clusters of open leveraged positions right at 78.5K. In algorithmic trading, these clusters act as a liquidity magnet. Price action naturally gravitates directly towards zones where stop losses and liquidations are densely packed. Market makers purposefully push the price into these concentrated zones. They trigger those liquidations to generate enough sheer volume to fill massive institutional orders without causing slippage. This connects right back to the S&P 500. The macro buffer provides the baseline market stability required for market makers to confidently execute this upward sweep. Given the current structure, this sweep is highly probable within the next few days, assuming traditional markets hold their ground. Retail traders fighting this magnetic pull by opening early shorts are simply providing the capital to fund the institutional sweep. The pull towards $78,500 reflects the mechanical incentives of market makers hunting liquidity, regardless of current retail sentiment, which exposes the ultimate contradiction right now. Despite macro strength and obvious liquidity magnets, the trading crowd is overwhelmingly bearish. This split chart proves it. Rising price on top, deeply negative funding rate histogram below. Because the crowd is heavily short, sellers are forced to pay a premium fee every 8 hours just to keep their bearish positions open. This creates an explosive setup. When the price moves upward, shorts are forced to buy back, triggering a violent short squeeze. Surviving these rapid volatility spikes requires a trading engine capable of executing trades instantly. Retail exchanges often freeze during these exact moments. That is why executing trades during breakout scenarios demands a professional-grade platform like BingX to completely eliminate slippage. You can utilize the partner link in the description to secure VIP bonuses and gain direct access to my ongoing market analysis. Identifying a market maker trap is financially useless if you are trading on a platform that stalls the second the squeeze actually triggers. Now, we need to look past Bitcoin and track exactly where this capital will flow across the broader crypto ecosystem. This chart tracks Bitcoin dominance. It is currently hitting absolute resistance at the 60.5% ceiling, setting up a potential rotation into altcoins. For Ethereum, price action will remain largely suppressed until it definitively breaks and holds the critical $2,400 resistance level. If that breakout fails, the primary fallback strategy is to bid the golden pocket support, sitting clearly at $2,250. Meanwhile, XRP is already testing its structural floor, confirming it is currently holding the critical $1.39 support level. Solana's price action against its $83 support suggests the broader altcoin rotation might face more resistance than expected. Before we look at that, remember the golden rule of this cycle. Never short a bullish trend when equities are at all-time highs and the crowd is paying negative funding rates to bet against you. Click the video on your screen right now to discover the exact Bitcoin dominance trigger that initiates true altcoin season, and I will see you there.